Hello, everyone. I'm getting ready to send out an email because I know Zoom was giving everybody some fits. One second. All right. Well, I hope y'all are doing well. I can see most people are starting to log in here, so hopefully, whatever issues people were having, um, it's going well now. So this session probably won't take very long. The last one at 8:30 only took half an hour. So there's just, it's a much easier material. So it's just not going to be as challenging, and typically students don't have as many questions. And so I'm going to go ahead and share my screen, and I'll also bring up the chat. So again, as always, you can unmute yourself and ask questions, or you can ask a question in the chat. Sorry, I'm just formatting everything over here. All right. All right, so whenever we have chapter 18, I'd say the calculations themselves really aren't a big challenge. Sometimes students might struggle identifying the kind of problem that it is, but if you go through the lecture guide and you go through everything and make sure that you take your time reading the questions, it's not overly difficult to figure out what kind of question is being asked. And with the online test, it's not like an open-ended question. So usually, it's kind of a directed question. And so hopefully that also will help you understand how to answer each question. So with this first one, this is a bundled sale. And so, there are 3 items in the bundle. There's a desk, chair, and bookcase. We have a price for the whole bundle together, which is $8,325. And then we have equal reliable prices for each item individually. So you can see if we add those up individually, the amount is different than 8,325. And so given that there's a disconnect between the bundle price and the sum of the individual prices, we have to figure out how to allocate the sales price. And so, with this or with any of these problems, the first thing you have to figure out is, what sort of method should we use? And since all the prices can be reliably estimated, the company should use the proportional method. And so the proportional method basically, that approach is you add up the individual fair values or prices, and then you apply each item's proportion of that price to the sales price. And so the first step then is to get the total estimated fair value, which we can see is $8,500. Of course, $8,500 is different than $8,325, which means that each of these individual prices is not going to be the way that we allocate the final bundled sales price. And so then again, applying the allocation to each item. For the desk, the proportion of the estimated price or estimated fair value is $5,000 out of the $8,500 total. Applying it to the bundled price tells us that we'll allocate $4,897 to the desk. We do the same thing for the chair, and we do the same thing for the bookcase. And so in that case, we have each final allocation is slightly different than our reliable prices, but again, there's probably some sort of discount for the bundle or something like that. And so when we allocate, we're going to allocate a slightly lesser amount to each item. Again, this is the proportional method, and we're using that method because all the prices can be reliably estimated. Any questions on that one? Okay. 49er Company provides consulting services to a client throughout 2020. The service includes a fixed fee of $22,350 and then a tiered bonus system depending on the client's performance in 2021. So 49 determines there's a 15% chance that it's not going to receive anything, a 75% chance that it's going to get 5,250, and a 10% chance that it's going to get 8,500. Now, one thing I highlight here is I said calculate the consulting revenue that 49er will record in 2020 as part of this transaction if it recognizes variable consideration using the expected amount. Now, the big thing here is the service was provided in 2020. And so we need to recognize the revenue related to that service in 2020 as well. The challenge, of course, is that um, there is the potential for a bonus, and that bonus is contingent upon future performance. In other words, the performance is going to occur in 2021, but we're recognizing revenue in 2020. And so, under US GAAP, if you can estimate the amount of bonus or revenue that's variable in the future, if you can estimate it, then you should record it at the time of the performance obligation was completed. And so in this case, we can do that. We have enough information to reliably estimate the expected amount. Another option would have been the most likely amount. So again, there's two ways that we typically do this. One is the expected amount, which is an average or a weighted average, and then the most likely amount is the one that has the highest probability. And in this case, we're asked to do the expected amount. So we're asked to do a weighted average. Now, if we had been asked to do the most likely amount, then we'd look at the probability distribution and we would choose the one with the highest probability, which in this case would be $5,250. But again, we're being asked for the expected amount. And so with the expected amount, again, we do a weighted average. And so the expected bonus, there's a 15% chance that you're not going to get anything. There's a 75% chance that you're going to get 5,250, and there's a 10% chance you're going to get 8,500. So the way we calculate that weighted average is the probability times the outcome. And so when we multiply and add across, we get an expected bonus of $4,788. Again, this is different than if we had reported the most likely amount. The most likely amount would have been $5,250. So then we add that expected amount to the fixed fee, and we would record as of 12/31/2020, we would record $27,138 in revenue. So that is what we recorded in 2020. And then in 2021, of course, there'd be an outcome, and that outcome 100%, it's going to be different than the 4,788. So whatever that difference is, you'd make an adjustment to revenue in 2021. So, there'd be like a debit or, a reduction to sales revenue for some sort of, adjustment for bonus or something like that. Or of course, if you got the higher amounts, then there'd be additional revenue that would be recorded to compensate for that difference. But for 2020, this is what we would record. Any questions? Okay. Next question. 49er Company is paid a $1,250 deposit on October 1st, 2020 for a party that will take place on November 15th, 2020. 500 of the deposit is non-refundable. The total bill for the party was $2,500, and the client made the final payment of $1,250 on December 1st. Provide the revenue amounts that 49er will recognize on October 1st, 15th, and December 1st related to this party. So before I give the answer, on your own, and if you feel so bold as to put it in the chat, feel free to put it in the chat. But let's put in your answers for each of those dates. So October 1st, November 15th, and December 1st. How much revenue will be recorded on each of those dates? Again, at a minimum, try it on your own. I would love it if you were bold enough to put it in the chat. All right, so I have a student who wanted to remain anonymous, who uh, who put October 1st. What is that? Oh, 12. I'm guessing she meant 1250. So she's saying October 1st, 1250, November 0, and December another 1250. Aaron says October 1st, 0. Kyler says October 1st, I'm assuming 500, which is the non-refundable component. Oh, so then so someone has 750 for October 1st. Somebody said December 1250. So I will say this, out of all the answers that I have seen, there's only one that's right. And now that person is wrong. All right, let's talk about this. Step 5 in revenue recognition says, recognize revenue when the performance obligation is complete. So in this situation, what is the performance obligation? Again, you can unmute yourself or you can put it in the chat. What is the performance obligation in this contract? So someone says a party.
Yeah, the party.
The party, right? That's the performance obligation, the party. Okay. So if we're supposed to recognize revenue, or what's the value of the party? According to this contract, what's the value of the party?
$2,500, right?
Yeah, it's 2,500, right? The bill is 2,500. They wouldn't do the party for 1,250. They wouldn't do the party for 500. It's 2,500. That's the value of the party. All right, let's put all that information together. Okay. So we recognize revenue when the performance obligation is complete. And the performance obligation is worth 2,500. So how much should we recognize on October 1st when none of the performance obligation has been completed? Yeah, 0, right? How about on November 15th when the performance obligation has now been complete? How much should we recognize? So how much is the performance obligation worth? So we have 3 different numbers. There's momentum kind of building for one number. Anybody want to change their answer? All right, it's 2,500. The value of the performance is 2,500. The performance is done on November 15th. That's when you recognize the revenue. Okay. So which means there's 0 on December 1st. So it's 0 on October 1st, 2,500 on November 15th, and 0 on December 1st. Now it's kind of maybe walking through the journal entries a little bit might help you. So on October 1st, when I receive 1,250, I'm going to debit cash and I'm going to credit unearned revenue, right? Because now I have an obligation to perform a party, but that obligation is in the future. I haven't actually done it yet. So I haven't earned one dime of that 1,250. Now, when I perform the party on that date, I'm going to credit sales revenue 2,500 because that's the value of the performance that I just completed. The debit is going to be 1,250 for unearned revenue, taking that off of my books, and then another 1,250 for an accounts receivable because now they owe me. I'm going to bill them. They owe me. So I now have a receivable for 1,250. And then on December 1st, the journal entry would be a debit to cash when I receive the payment and a credit to the receivable. But sales revenue is recorded on November 15th and only on November 15th. Even with the non-refundable portion of the deposit is inherent to providing the party. In other words, they paid me the deposit because they wanted me to do a party. They didn't pay me a deposit because they just wanted to give me $500 because they thought it would be fun. They did it to get a party. Now, at some point, if they canceled the party, if they say, hey, I don't want to do this anymore, well, then I get to keep the money and then I can recognize the revenue. But I can't, as the caterer, I couldn't say, hey, you know what, that party I was going to do, not going to do it now, but thank you for the $500. I appreciate it. Right? I can't do that. Right? I'm obligated to do the party. And so I need to be able to do that. And even with the $500, it doesn't matter. It could be refundable, non-refundable, separate check, same time, different time. It doesn't matter. It's for recognizing revenue. You recognize revenue when the performance obligation is complete. And that happens on November 15th and only on November 15th. Okay? This traditionally is the most commonly missed question that I give on any test. And, it's not necessarily a party, but I'm saying this timing of payments compared to action. Students always struggle with this, and I get why. The interesting thing is, if you go all the way back to Principles 1, you had stuff like this all the time. You'd get a payment, you'd do the work, and you'd have the unearned revenue, and then you record the revenue. And it was easy for you to think about it that way. But as soon as I put it all in one package, when I say here's the full economic event, and when I have a prepayment, then a post payment, all of a sudden the wires get crossed and everyone just kind of blanks out. But remember, there's basically two pieces of this. There's an unearned revenue, a prepayment, and then there's a receivable, which is a payment after the fact. Well, you've done those transactions a million times. And so that's not really new. It's just this context is new. And so if you just kind of work through it, think about, again, back to that, when is the performance obligation completed? That's when I recognize the revenue. Okay. Any more questions on that one? So someone asked, if the party had been canceled, how much revenue would you recognize? Then you would only recognize the $500 non-refundable deposit. Again, that would only be if the client canceled the party. If I canceled the party because I got sick or something like that, I would have to refund them the deposit.
Would you recognize it on the 1st of October then?
It would be on the cancellation date.
Okay.
Because that's the point at which I would have actually earned it. Any other questions? All right, so this next one lists the 5 steps of the revenue recognition process. Given this is open book, open note, I do not think any students would miss this on the test. But I just want to remind you, the 5 steps: identify the contract, identify the performance obligation, determine the transaction price, allocate the transaction price to the performance obligations, and then recognize revenue as each performance obligation is complete. So, there's usually a few sort of identification questions here. You just need to know the 5-step process, and hopefully by the time you get through the studying and the lecture guide and this again, it's just sort of getting cemented in there. And so even now, like if I walked away from this and for some reason somebody decided, hey, do you know the 5-step recognition, 5 steps in the revenue recognition, like I would be able to think about it and come up with them. I wouldn't just be able to rattle it off. I probably could at this point just because I just went over this. But I'm saying, just randomly, 6 months from now, you should be able to kind of get at these 5 steps. It's just that important. It's so fundamental to to the way we recognize revenue. Just having this idea of contract, performance, price, allocation, recognition. That just sort of those 5 things. To be a professional accountant, that just should be something you internalize. So, you're going to have access to your notes for the test. So I'm confident you'll get it right. But I'd also just encourage you to really start to internalize these 5 steps and at least have a notion of what each of them involves. And by the way, it's the same 5 steps under IFRS. So this is actually a situation where IFRS and US GAAP have converged. So the two standards are 100% converged. All right, this is the last problem and the one we'll probably spend the most time on. I'm not even going to say anything. All I want you to do is try to fill in the table on your own. And again, and you can put it in the chat, you can do it on your own, whatever you want to do. But I want you to fill in this table on your own. And again, I'll give you, several minutes to do it. Maybe another minute or so. Okay, so we're just going to kind of go through each piece here. First of all, with the N, under US GAAP, unless there's a payment that kind of determines how frequently you should record or accrue revenue or accrue interest, I should say, the N is always going to be in terms of years. And so in this case, of course, the sale took place on May 1st, 2020, but payment is not going to occur until 14 months later at the end of June. And so the N is 14/12. So basically 1 year and 2 months. So 14/12. That's our N. I'm going to jump to the payment next, which is kind of an easy one. There's no contractual obligation to pay any kind of interest on this. So there's no payment. There's no recurring payment that's part of this contract. The contract does call for a payment in the future. And so in 14 months, 49er Co-op must pay John Deere $214,300. And so again, this is John Deere's perspective. And so John Deere is going to receive $214,300 14 months from now. And so that's why we have the positive $214,300 as the future value. Then our choice really is between these two items. And we have to, the way that the time value of money works, again, under US GAAP, if there's a significant delay in payment, which is defined as, well, significant can be shorter than a year, but if it's a year or more, by definition, it is significant. And so US GAAP, in that situation where there's a significant delay, they infer a financing arrangement. And so we need an interest rate, we need a present value, we need this information in order to calculate the inferred interest that's part of this transaction. And so really our choice is we either can use an estimate for I/Y and solve for PV, or we can use an estimate for PV and solve for I/Y. We just have to determine which of these I can more reliably estimate. And in this case, we are told that the cash value of the equipment is more reliable than the discount rate. So what they're telling us is this PV, the present value of the equipment, is more reliable than the 8.5% discount rate. And so that means we put in our most reliable estimate for the present value, and then we solve for the I/Y. So the PV, again, they're giving up a piece of equipment that's worth $195,000. So that's a negative economic flow. And then we solve for the I/Y. And yes, so the setting should be end, because this future value payment occurs at the end of the 14-month period, not at the beginning. If we did the beginning mode with no payment, the present value and future value would be the same. All right, so now that we've done our TVM, we could do an amortization table. So someone asked, when do we have begin? For all of these, they're begin. So if there's, for the only time it's a begin is if you have recurring payments, and those payments happen at the beginning of each period. So when we do leases, we will use the begin setting because for some leases, the payments happen at the beginning. So now we have the information we need. We could do a full amortization table, but there's really no need to do one here. There's nothing wrong with doing one. It's just we don't have to. So I didn't when I solved it. So let's kind of walk through this. So the first entry on May 1st is the time of the transaction. And of course, on this date, we have a receivable for $214,300 because we have this payment that's going to be coming in the future. And the value of that payment is $214,300. Now, for me personally, if it's just a one lump sum, I usually use accounts receivable. If there's a recurring payment that's part of the contract, that's typically when I use a note receivable. But either one is fine. On the test, I don't have you fill in this account name, so you don't have to worry about that. But again, that account receivable is the future payment. The next piece of it is the sales revenue. Now it's very important. The sales revenue amount is the present value that's part of this TVM calculation. And so the 195,000, that's the present, that's the present value. So that is the sales revenue that we'll record. Now notice the total payment and the sales revenue are different amounts. Now, whenever that happens, which anytime there's a significant delay, that is what's going to happen. The difference between the two is the inferred interest that's part of this transaction. And so again, because there's a significant delay, we infer that this sale includes both sales revenue and interest revenue. The sales revenue is the present value, and the interest revenue is then any amount above the present value. Now, of course, the interest revenue does not get recognized right away because the only way to earn interest is for time to pass. No time has passed, so I can't record any interest revenue. Instead, I have this discount on accounts receivable that is, if you remember in the chapter where we did bonds and we said, or notes, we said that interest expense was a function of the interest payment plus the discount. The same is true for interest revenue. Interest revenue is a function of any required interest payments plus any discount on whatever debt or whatever lending arrangement that I have made. And so in this case, there is no contractual interest payment. And so the only amount of interest revenue will be the amount of the discount. And so between May 1st, 2020 and June 30th, 2021, when the accounts receivable is due, we will in total recognize $19,300 in interest revenue. That is what this account captures. Now, the timing of it will be the amortization of the discount. As we amortize the discount, that's when we start recording interest revenue. And under US GAAP and under IFRS, we must use the effective interest method. It is not acceptable to use the straight line method. I'm going to say that again. You cannot use the straight line method to recognize interest revenue with this type of transaction. And the reason why I keep saying that is because every semester, like a third of students use a straight line method in this kind of problem, and then they get all the numbers wrong. Okay. You cannot use the straight line method. You must use the effective interest method. Now, with the effective interest method, there are sort of two things that would prompt, well, potentially three things that would prompt a journal entry. One would be an interest payment. There are no interest payments on here, so we don't have to worry about that. Number two would be a fiscal year end. There is going to be a fiscal year end, so we absolutely need to worry about that. And then third is the repayment or the payment on the receivable. And of course, that's going to happen as well. So there's two additional journal entries that we have to consider with this problem. One is the December 31st, 2020 fiscal year end, and two is the payment on June 30th, 2021. So we're going to do the December, sorry if I could get it all there, the December 31st, 2020 journal entry. There are two accounts. First of all, we will be amortizing the discount. That's what we're doing. And as we amortize the discount, that's when we will record interest revenue. Now, the entry amount is using the effective interest method. Now, the effective interest method basically says take your carrying value, which the initial carrying value is 195,000, multiplied by the interest rate, which is 8.4257%. But remember, this total amount would be for 1 year of interest. Well, between May 1st and December 31st, there's only 8 months. And so the only amount of interest that I recognize is 8/12 of that total amount. So 8/12. Now, I didn't say 8/12 of 9. I want to be very clear. This is not 8/12 of $19,300. This is the amount of interest that I would record between May 1st, 2020 and April 30th, 2021. That's this number right here. That's the interest that I would recognize in between those 12 months. However, 8 months of that occurred in 2020. So that's why I'm recording only $10,953 on that date. I do want to stop there just to make sure we're clear. Does everyone understand this is 8/12 of, let me just do the math. So 195,000 times 8.425% is $16,430. So $10,953 is 8/12 of $16,430. If we had created an amortization table, that would have been the interest revenue in that first row. So again, so now we've gone past the fiscal year end. The only thing left is the payment on the note. So on June 30th, 2021, we have the payment on the note. So someone asked why 8/12? Because between May 1st, 2020 and December 31st, 2020, that is an 8-month period. And so 8 months, so this amount, this 195,000 times 8.4257%, which is 16,430, that would be 12 months of interest. We're recording the interest that had been accrued for the 8 months that were in 2020. That's why we're using 8/12. All right. So now the easy part. On this date, of course, they're going to make the cash payment. So I'm going to debit cash 214,000. And of course, when they make that cash payment, we're going to take the accounts receivable off of our books. The only part now left is we do need to continue to amortize our discount. And we then, of course, as we amortize our discount, we record our interest revenue. We just need to figure out the amount that we're going to record. The amount that we're going to record is $8,347. Now, the reason why is we already said the total amount of amortization is $19,300. We had already amortized $10,953, which means the only remaining amount to amortize is $8,347. So that is our final journal entry. All right. Any questions on this problem or any of the other problems? So someone asked, so if the 8.5% was more reliable, then you'd use that instead of the 195. 100% true, right? So if we had determined that the 8.5% was more reliable, we'd put in 8.5% for the I/Y, and then we would solve and have a different present value. That different present value would be the sales revenue, which means there'd be a different discount, which means there'd be a different way to, we'd have a different calculation here, which means we'd have a different calculation here. No problem. And I think in the book I did both. So do we have a review session next Thursday? Yes. So that will be chapter 19 review session. So I had scheduled it for the week after, but my family and I are going to Arizona. We're going to the Grand Canyon. And so I thought rather than hope that I have a good internet connection in Arizona somewhere, it'd be wiser to have our review session next Thursday. So the test is Tuesday, and then it's a somewhat of a short turnaround for Thursday. Thank you. Appreciate that. So someone asked so we don't use the 8.5%. True. We do not use the 8.5% because it is less reliable. And then someone asked if I'm going to tell you on the test, and I'll say, I don't remember the test question exactly, but it'll either be very obvious or I will explicitly tell you as far as which one's more reliable. And again, I don't remember the test question. I just know that it's clear. So if it doesn't say explicitly, use levels. Yep, 100%. Yep, that's right. But in this case, of course, both of these would be a level 2. So that's why I told you which one, because there'd be no way by looking at this, I don't know how I would discern which one is more reliable. Good questions. Are there any other questions on the previous problems or chapter 17 questions or anything like that? I want to give you, we have time, so I want to give you an opportunity to ask those. Sorry, I'm bringing this back over here. All right, well, feel free to log off. I'm going to stay on, maybe another minute or two in case somebody has any more questions, but don't feel any obligation to stay on.
Professor,
just,
for
yeah.
for next Thursday, that's when we have our first conference tournament game, so I probably won't be able to log on. Will that be an excused absence?
Yes, that's 100% excused. Yep, no
Okay.
problem.
Thank you. I can email you too to remind you if you need me.
That'd be fantastic. I appreciate that.
Thank you.
I have a quick question about the final. Is it going to be the same format as the rest of our tests?
Yes, as far as the type of question and things like that, I'd say the difference is that with the final exam, the depth is it's not as deep. So it's sort of like on these tests, it's really deep, not very wide. The final exam is very wide, not as deep because you're covering 10 chapters.
But it'll still be open note as well.
Oh yeah, open note, open book. Yep.
Okay, great. Thank you.
Uh-huh. Any other questions?
So for the exam, do you know how much of it would be like kind of qualitative and quantitative on it?
Chapter 18 has a lot of qualitative sort of concepts, so that one's definitely heavily weighted towards that. Chapter 17 is mostly quantitative, and so that's going to be largely quantitative. So I don't know the exact mix. It's an even number of points. So there's 50 points that come from chapter 18, 50 points that come from chapter 17.
Gotcha.
Probably at the end of the day, it's slightly more quantitative than qualitative, and most of that quantitative is going to be from chapter 17.
Okay. And then just for studying, the best thing to view is the review sessions, the lecture guide, and then the PowerPoint and the book as well.
So I would say lecture guide first.
Mm-hmm.
Know those problems and examples and concepts. Review sessions second.
Okay.
Practice problems from chapter 17 third. And then the book would be a supplement after that. I mean, I'd say if you did those first three really well, the book's more of a supplement. Like if there's something like, okay, I don't quite get this from the notes, maybe I can look in the book and supplement it.
Gotcha. And then I had something on it for the lecture guide in the book. There was something like on one of the problems you said you were going to post in like the fair value adjustments because it wasn't in the lecture. And I was trying to see where that was at
Yeah, it's
on
in
the Canvas.
Canvas.
It's in Canvas.
Canvas is being a little squirrely today, but so in Canvas, where there are all those lecture guides, there's an extra one that says like Chapter 17 fair value adjustment, and it's just a one-page piece of paper with all the information filled in.
Okay. Alrighty. Just wanted to make sure on that one. Okay.
Yeah.
Yep. Thank you.
No problem. All right, everybody, take care.